There are many different ways to manage your superannuation. Some ways are very simple, low cost, but they don't give you a whole lot of flexibility. And other ways give you all the flexibility you could want, but come with added complexity. And today we're talking complexity. We're talking self-managed superannuation funds, which give you all the flexibility you could want, but they come with added complexity in terms of the tax, compliance, and administration obligations that you need to follow. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. For those of you who don't know, a self-managed super fund is basically a superannuation fund that you run yourself. You're the trustee of the fund, you set up the fund, and you're responsible for maintaining and managing that fund on an ongoing basis. And like most things in finance, running an SMSF is good for some people and it's appropriate for some people, and it's not appropriate for others. It comes with its own set of pros and cons, and whether or not it's going to be right for you is really going to depend on your individual circumstances and what you're trying to achieve. So today I want to run you through some of the reasons why you might start an SMSF and some of the reasons why you might not start an SMSF. Unfortunately, I see it all too often that people start their own self-managed superannuation fund for the wrong reasons, and this simply just adds to extra complexity in their life and often extra cost as well. So let's kick things off with some reasons why you may want to start a self-managed superannuation fund. To purchase an investment property, Australians love investing in physical property, and a self-managed super fund allows you to do this using your superannuation funds. To purchase a commercial property for your business, now business owners may be able to purchase a commercial property via their self-managed super fund and use the property to operate their own business. This means that you can pay yourself rent or your super fund rent rather than paying a third party. Purchase of other unique asset classes. So through an SMSF, you can basically invest in anything you like, provided you operate within the rules. So this opens up your world of investing to assets such as cryptocurrency, artwork, basically any shareholding worldwide, physical commodities, or really any asset that you can justify has a good investment case. The ability to pool superannuation balances. So you can currently have up to 4 members in a self-managed superannuation fund, but there is legislation in the pipeline that's aiming to increase this to 6 members. And this allows you to combine balances with your family and friends to purchase larger assets that you otherwise wouldn't be able to fund yourself. You have the ability to borrow inside superannuation. Although typically I think this is a really bad idea, you can actually borrow inside superannuation to leverage into large assets such as property. You have additional capital gains tax flexibility. So by operating your own SMSF, you can transfer assets from accumulation phase to pension phase to avoid an accrued CGT. Now, many public offer funds will force you to sell assets upon transition from accumulation to pension, which will realise a capital gain and lead to a CGT event. You have the ability to defer contributions tax. So the payment of contributions tax is deferred until it's actually due. This allows the investment earnings to accrue on those funds until they become payable, whereas many large public offer funds out there will actually deduct the tax from a member's account at the time the contribution is made. Estate planning. SMSFs generally have better flexibility when it comes to the payment of death benefits over a typical public offer fund. And finally, cost control. As you're in charge of operating the SMSF, you have control over the platforms and the services that you use, which means that you do have some control over the operating costs. However, please bear in mind that SMSFs typically are not cost effective for small fund balances, as there are a number of fixed costs such as annual accounting and audit fees. So as you can see, there are a lot of potential benefits that come with an SMSF. But like with most things, with the good comes the bad, and now we need to look at the cons. These are some of the reasons why you shouldn't start an SMSF. And not all of these reasons are going to apply to you, but before you take a plunge and start a self-managed super fund, consider these first. There is considerable work involved to run a self-managed super fund. As the trustee of your own fund, you're going to be responsible for the compliance, administration, and the investment of the fund. Now, there's a lot of work involved and knowledge needed to do this to an acceptable standard. But of course, you can take on a financial advisor to assist, but this is obviously going to come with additional costs. There are many fixed costs with running a self-managed super fund. So although SMSFs give you more flexibility around costs, as we previously touched on, they're typically not cost effective for small fund balances due to necessary fixed costs such as accounting and audits. It's generally advisable that you shouldn't start an SMSF unless the fund balance will be greater than 300,000. There's restrictions around living overseas. So in order for your funds to remain compliant, the majority of SMSF members must permanently reside in Australia. Generally, members cannot reside overseas for longer than 2 consecutive years. Often, flexibility can lead to poor investment outcomes. Some people use an SMSF as a means to invest in highly speculative asset classes. And unfortunately, this often ends in tears. Now, I'm not against using a small amount of money to speculate, but retirement savings should generally be invested in rock-solid strategies which preserve capital as much as possible. In other words, don't gamble with your retirement funds. There's an inability to access government compensation schemes, so SMSFs cannot access government compensation schemes in case money is lost for various reasons, including those outside the control of the trustees. So with the good comes the bad, and I can't stress enough the importance of understanding the compliance obligations that come with operating your own SMSF. This is something that shouldn't be taken lightly. And I do worry that a lot of people start an SMSF as a bit of a status symbol. It sounds real fancy and it's got that extra complexity, and a lot of people think that complexity leads to more sophistication. But in reality, complexity often just leads to a headache. Most of the time, it's the simple financial plans that are easy to execute that are the best ones. If all you want to do is have a nice diversified portfolio of stocks, bonds, maybe a term deposit or two, then you really don't need an SMSF. There are a lot of public offer funds out there that will allow you to do exactly this without the necessary compliance burden. Some of the public offer funds out there today really are quite extraordinary. They offer an amazing array of investments, they have really good reporting, all at a reasonable cost. I personally don't have a self-managed superannuation fund simply because I don't need one. The super fund I use gives me all the flexibility that I need to implement the portfolio that I want. And so there's really no need for the extra complexity and costs when it comes to managing my own superannuation. Now, in the future, I may consider a self-managed super fund, and the only reason why I think I would do that is if I wanted to buy an office to run my business out of. Apart from that, I can't see myself using one. But if you do decide an SMSF is right for you and you want to go ahead and start one, then this really is an area where I would suggest you get some professional advice, just to make sure that you're on the right track from a compliance perspective and that you're not missing anything. Now, if you want my help with that, feel free to reach out and I would be happy to help. But that's it for me today, guys. Thanks a lot for watching. I hope you liked this video. If you did, please give it a thumbs up and I will see you guys in the next one.